Hey everyone, welcome back to Corporate Decoder, the place where we decode the corporate jungle and reveal its secrets. Don't worry, it's not all doom and gloom. We've got a new filing to dissect today, and it involves a little bit of financial engineering. Before we jump in, if you like getting clear, unbiased insights into what companies are actually doing, make sure you hit that subscribe button and ring the bell. We also have a fantastic Discord community linked in the description where we break down these filings together. So come join the conversation. Alright, today we are looking at Mirion Technologies Inc., a company that operates in the radiation detection and measurement space. Not exactly something you see every day, but important. Nonetheless now, this filing is a Form 8K, which is essentially a report of major events that shareholders should know about usually pretty quickly. The main story here is a refinancing of some of their debt. This is a pretty common move for companies, especially when interest rates or their financial situation changes. In this case, Mirion entered into Amendment Number 6 to their credit agreement on the 8th of December 2025. Now, this is not a new loan entirely, but an amendment to an existing one that has been modified quite a few times since October 2020. So what exactly did this amendment do? Well, it introduced a new chunk of money, specifically a $450 million tranche of term loans that are due in 2032. The big news is that the money from these new loans, along with some other cash sources, was used to pay off all the old term loans that were outstanding before this amendment took effect. This is like taking out a new mortgage to pay off your old one, perhaps to get a better interest rate or different terms. Let us talk about the cost of this new borrowing. The applicable margin, which is basically the interest rate added on top of a base rate, is set at 2.00% for what they call term SOFR loans and 1.00% for ABR loans. ABR stands for alternate base rate, which is usually a bit higher than SOFR. That means the new debt is priced at about these rates, and there is a potential for 0.25% reduction in these rates if they achieve and maintain certain credit ratings from Moody's and S&P. This is a good sign that the company is aiming to improve its financial standing and reduce its borrowing costs. Now, for something that sounds a bit technical but is important for understanding the cost of borrowing, these replacement term loans have a SOFR credit spread adjustment of 0.00% and a SOFR floor of 0.00%. What this means is that the interest rate will directly follow the SOFR rate with no extra spread added on top. And if SOFR goes down to zero, the interest rate will not go below zero. This is significant because if market interest rates were to fall drastically, this feature would protect lenders, but in a rising rate environment, it means the company benefits fully from any rate decreases. The company has pushed out the maturity date for these new loans to the 5th of June 2032. This gives them a longer runway, a bit more breathing room before they need to repay or refinance this large sum. This is a strategic move to align their debt maturity with their longer-term business plans. However, there is a catch-up prepayment premium of 1% will be applied if these new loans are refinanced or repriced within 6 months of the date of this amendment. This is pretty standard practice. It essentially discourages the company from immediately trying to get an even better deal on this same debt if market conditions shift favorably shortly after this agreement was made. Now, this next part is short and sweet. It basically says that the details we just covered in item 1.01 about entering into this new credit agreement are also relevant for item 2.03, which deals with creating new financial obligations. So all that information about the $450 million loan is directly tied to a new financial obligation for Mirion Technologies Incorporated. And finally, we get to the exhibits. Just like any other filing, this one includes the actual document that details this amendment. Amendment number 6 to the credit agreement is listed as Exhibit 10.1. This is the legally binding document that lays out all the specifics of this refinancing. We do not need to dive into the nitty-gritty of the entire contract, but it is good to know where the official record is. So looking at this filing from Mirion Technologies Incorporated, what does it all mean? Well, on the surface, it is a refinancing, and that is often a good thing. Companies take out new loans to pay off old ones, to get better interest rates, or to extend their repayment timelines, which provides financial flexibility. In this case, Mirion has add $450 million in new debt due in 2032, and they used it to replace their existing term loans. This suggests they are likely seeking more favorable terms for their borrowing, perhaps lower interest rates, or a longer repayment period, which are generally positive steps for financial health. The fact that they are focused on achieving better credit ratings also indicates a commitment to financial discipline. However, it is important to remember that this is still debt. Mirion is taking on a significant financial obligation. The prepayment penalty is a clear indicator that they want to lock in these terms for a while and are not expecting immediate further improvements that would warrant a quick refinance from a shareholder's perspective. This refinancing can reduce interest expenses. Ing up cash for other business needs or investments, or it could be a sign that the company needed to restructure its debt due to financial pressures, while the report doesn't paint a full picture of their financial health. This move to refinance debt is a proactive step. Overall, Mirion Technologies Incorporated is actively managing its financial structure to its advantage. The $450 million Ray. Financing with a 2032 maturity date suggests a long-term perspective, but as always, the real test will be how they perform operationally and financially in the coming years to service this debt and grow their business. What are your thoughts on this debt refinancing? Let us know in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate insights. Don't forget to join our Discord community. It's the perfect place to continue the conversation and ask your questions. Thanks for watching, everyone, and we'll see you in the next one.